What's up guys, Nick here, back with another video. Last year Uber finally went public on May 9th of 2019, and while there was a ton of buzz around Uber stock, the share price growth didn't really end up matching with the IPO hype. As of November 2020, the share price was down 19% from the IPO price, but ended up finishing out 2020 strong and is now up an all-time 22%. After what has been a very difficult year for a lot of different companies, I thought I would take a look at how Uber's business is actually performing, what's the stock worth, and is it worth buying now? Uber started in 2008 when the two founders, Travis Kalanick and Garrett Camp, were attending an annual tech conference in Paris. Both founders had just cashed in a combined $94 million after the sale of their previous startups. Kalanick had sold Red Swoosh to Acme Technologies for $19 million, and Camp had sold StumbleUpon to eBay for $75 million. One night during the conference, the idea that would become Uber was born after the two were unable to catch a cab. The initial idea was to create an app that would allow users to order a timeshare limo. When Camp returned to San Francisco, he started work on a side project that he would call Uber Cab while continuing to work as CEO of StumbleUpon. Camp would go on to bring Kalanick on board, who would become the CEO of Uber Cab. And eventually, after a cease and desist letter, they were forced to drop the name Cab from the business and became what we all know them as today, Uber. The app ended up catching on because of the overall simplicity and convenience. Since then, Uber has grown to 111 million active monthly users by the end of 2019, and in the last quarter of that year alone, they facilitated 1.9 billion rides. Uber breaks their whole business down into 5 segments: mobility, delivery, freights, other bets, and the Advanced Technologies Group, also called ATG. Most of us know what the mobility and delivery businesses are, Uber Eats and Uber Rides, so I won't spend much time on this. But just in case there are some who don't, Uber Mobility is the main segment we recognize the company as. They connect passengers and drivers through the Uber app. Riders request rides, and nearby drivers will pick up the passenger and drive them to the requested location. Uber makes its money by taking a cut out of the sale. Uber Eats is a similar concept where customers will order food from a restaurant. The driver will go to the location, pick up the food, and then deliver it. This makes it possible for any restaurant to have deliveries, but this does come with a cost. They charge a pretty big fee to the restaurants for the service, 30% for delivery and 15% for takeout. Uber allows restaurants to negotiate lower rates, but usually those rates aren't much better. This has come under some criticism because of all the hardship restaurants have faced in 2020. However, it is possible that if it wasn't for rideshare delivery services, that these restaurants would have even less traffic. The third segment is Uber Freight. I think this is a pretty exciting segment. A major issue for truckers is the technology behind dispatching their trips is very far behind current capabilities. They rely on freight brokers who are using phone calls and fax machines to connect drivers and cargo. Uber Freight aims to do to the freight brokerage industry what Uber did to the taxi industry. Truckers download an app on their phone and shippers list freight requests on the app. Truckers can instantly see a list of open order requests, where the route is going, how much it pays, and make a more time-efficient plan. The 3 to watch out for in the digital freight brokerage market is Uber Freight, Convoy, and in the Northeast US, Amazon Relay. Uber Freight and Convoy are continuing to gain national market share over traditional services called load boards. These big companies in the freight brokerage business have started to release apps, but they don't leverage the potential to integrate into smartphone apps. C.H. Robinson, the current leading freight broker in the US, has an app, but you still have to call a representative for the load offer and negotiate a deal over the phone only. These apps don't seem to be much more advanced than Craigslist. Other bets are a bunch of smaller businesses like the e-bikes, e-scooters, and the Platform Incubator Group, where they develop new ideas for new services. The last segment is the Advanced Technologies Group. This is the segment that handles the development of autonomous vehicles and ride-sharing technologies. They had partnered up with Toyota and Denso to help development, but as of December 7th of 2020, Uber announced they were selling the entire Advanced Technologies Group to a startup company called Aurora for $4 billion. As a part of the deal, Uber will gain a 25% stake in Aurora, so this doesn't seem like this segment is fully gone from Uber's business. In June of 2017, co-founder Travis Kalanick stepped down as CEO of Uber after major investors called for his removal. There were issues with sexual harassment within the company, as well as a confrontation with an Uber driver over how the company was paying its drivers. The new CEO, Dara Khosrowshahi, took over, and his big challenge has been to try to find a way to make Uber profitable. So let's take a look at the money and get an idea of how things are going and if that even seems reasonable. So here's their revenue, operating income, and net income from 2015 through the most recently reported numbers. It's pretty surprising just how big the losses that Uber is taking, and that number has only continued to get worse through 2020. One thing that stood out to me is the operating loss in 2018 versus the net income profit they showed that year. That happened because of the sale of Uber China. Uber sold Uber China after aggressively targeting the Chinese market, spending a total of $2 billion in the area. The established competitor, Didi, who is backed by all three of the major tech giants in China, still maintained an approximate 80% market share. Uber decided that it would be smarter to sell the business and focus on better opportunities. So here's the revenue in comparison to their operational expenses. We can see exactly where they've spent their money and how it compares to the revenue. I think one of the difficulties for Uber's current business model is their cost of revenue is accounting for half of their revenue. In general, this isn't too bad, but this is higher than I had expected. In comparison, another tech company, Airbnb, only spent about 30% of the revenue on the cost of obtaining that revenue. Research and development and sales and marketing both take up big chunks of the operational expenses. Personally, I think as long as these end up continuing to drive growth and a better product, I don't really mind these expenses very much. In bad time, these could be trimmed to conserve cash, and we can see how they've done that somewhat during 2020. So here are the 5 individual segments at the same scale. We can see how mobility is clearly leading all of their segments, and also the only profitable segment. Keep in mind that the Advanced Technologies group has been sold off, but I included it so we could see how it was looking. If we adjust the scale of freight, other bets, and advanced technology, we can see how these other businesses are performing better. All of these are obviously on a much smaller scale, but freight seems to be the only potential winner of the group. Taking a look at their balance sheet, they most recently reported $29 billion in assets to $19 billion in liabilities. This gives them just about $10 billion in equity. They reported $6.6 billion in debt, so this is a very healthy balance sheet with a debt-to-equity ratio of 0.66. They also reported $6.1 billion in cash. So let's take a look at the valuation. But before I do that, if you could take a second to help me out by hitting the like button, I would really appreciate it. These videos take a lot of effort, so if you found it helpful, please help me out with a quick thumbs up. So here's the most recent year of revenue and profit for Uber, and the 2020 full year forecast plus the 2021 forecast. It looks like they're projected to recover from a rough 2020 and cut their losses to a little over $2 billion. If we switch over to revenue growth, we can see the big drop off in 2020 that we would expect, but revenue is currently forecasted to return to over 20% growth. Because Uber isn't profitable yet, we have to use a price to sales ratio to come up with a valuation. I think what's tough about this valuation is figuring out exactly what type of profit margin they'll eventually be able to achieve. I'm going to use a general 5 to 10% range, but we'll have to wait and see how this turns out. So 20% growth comes out to a PE of 57, and that 57 PE multiplied by 5 to 10% for the expected profit margin makes the fair price to sales ratio 2.85 to 5.7. On the day I'm recording this, Uber shares trade at $51, which is a market cap of $89 billion. It's very easy to go onto Yahoo Finance and check it out. So taking the trailing 12 months 2020 revenue of $13 billion, this gives them a valuation of $37 billion to $74 billion, or $21 to $42 per share. Looking to the end of 2021, Uber is forecasted to earn almost $18 billion in revenue. This gives us a valuation between $51 billion to $101 billion. So this top end number is just slightly above the current valuation. I thought for this video, I would make a chart explaining what this means in relation to the current share price. I took the 2021 forecast and the estimated forward valuation using the 20% growth rate we expect for Uber and what that would mean for the valuation going forward. When I talk about valuation, this is visually what I'm trying to explain. The orange line is the current share price. The more you pay per share, the longer you have to wait for the underlying value of that company to meet that price, assuming it will. Price is what you pay for something and value is what you get. The lower the price, the better the value. This also is why when a stock drops, you should feel good about buying more. The only time you wouldn't is when there's reason to doubt the future valuation. One thing I think also worth pointing out is what the future value of this company looks like. If growth continues at least 20%, this would mean you could expect to double your money by 2026. So I think the current share price is very reasonable. I see Uber as a business that fills an important need that isn't going away anytime soon. I would not have any issue with buying shares at the current price, but I would be more interested in getting them for a little less, around $45 to $40 per share. Now I do own some Uber stock already. I had bought at the beginning of November for $35 per share after reading the polls expected the California proposition to allow Uber and Lyft to keep classifying their drivers as independent contractors was expected to pass. I don't have any plans to sell anytime soon, and I'm looking forward to seeing how the stock does in the future. So that's the video, and if you found it helpful, please make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.